Welcome to the Canadian Dividend Investing Podcast, an investing podcast by DIY investors for DIY investors. Join host Nelson Smith and guests as they discuss investing, business, and economics, all from a Canadian perspective. This podcast is meant for entertainment and research purposes only. Canadian Dividend Investing urges everyone listening to seek advice from a qualified professional before making any financial decisions. Enjoy the show.
Welcome to Canadian Dividend Investing. I am your host, Dividend Dave, and as always, with me is Nelson. In this show, we will analyze 3 under-the-radar Canadian small caps. Nelson, are you ready to dive in?
I have never been more excited in my entire life. Can you tell by my face?
I cannot tell.
Oh, well, maybe I should start being a little more excited. All right, Dave, I'm so ready. Let's go. Is that better?
Awesome. Now, we did talk a little bit about this in last week's episode, Canadian mid and small caps, and how there is potential there, potential that we don't often see. We so often in Canadian investing just get focused on the large blue chip stocks, your Enbridge, your Bell Canadas, your rail lines, and all the companies that everyone is familiar with. So let's take a look at 3 small caps that you think have some great potential.
It'll depend on each small cap. So for sure, all 3 of these do have growth potential, but that's certainly not the thesis for each one. They each kind of have their own individual thesis that we'll get into more as the pod goes along.
Okay, so first up, we're going to talk about Canadian REIT. And what is the ticker symbol for this company?
So this one trades on the TSX Venture. It is NET.un. Of course, the .un is the ticker for any REITs or any kind of similar company. So that one is on the TSX Venture, and it is quite small. I think it's got about $100 million market cap. So we're looking small to begin with here.
Right. So first up, a little background. What is it? What do they do?
Sure. So obviously they're a REIT. These guys buy triple net real estate in Quebec, which we'll talk about the triple net aspect of it in a minute, because I think that's a very unique, very special kind of actually have. So yeah, these guys are a regional REIT that operates in Quebec. Their head office is in either Montreal or a suburb of Montreal. We'll call it Montreal. And they buy kind of single tenant, freestanding real estate. So things like fast food franchises, they have some grocery stores, et cetera. It's typically freestanding retail real estate. There's about 100 properties that they have right now.
Okay, interesting. Triple net. I guess first, what is the meaning of triple net and why is it so interesting?
Sure. So triple net is a type of real estate where the tenant pays virtually all of the operating costs. Now, this varies from lease to lease, but typically the tenant will pay for maintenance, they'll pay for insurance, they'll pay to fix the roof, they'll pay for the parking lot, they pay for virtually all of the expenses. And typically what happens is the REIT or the owner itself pays for just the property taxes, and then the tenant pays the rest. So what makes that such a valuable kind of asset class? There's 2 reasons. One is that it creates a very predictable kind of return situation for the owner, because you don't have these expenses that pop up that kind of eat away your returns. They don't have to talk to the tenant about any of that stuff. They just buy it, sign the lease with the tenant, and the tenant worries about it. And the only thing head office really has to worry about is just buying more properties or renegotiating the leases with tenants as they come due. And, that's much simpler than owning the real estate and having to deal with all of the kind of the operating costs yourself.
Right. Very fascinating. The one other thing that the owner of the REIT has to do is sit back and collect the money. Just let those lease and rent checks come in.
That's it. And pay the dividends to guys like me who hold it. And, that's why we hold REITs. We want those attractive dividends or distributions, I guess. Of course, we pay slightly different than dividends.
Before we get to talking more about dividend, because obviously I do want to talk about that, but as a small cap, I need to ask about the growth potential.
So that's one of the advantages of triple net real estate is that there's less for head office to do besides kind of looking and buying more properties. Triple net real estate scales a lot better than office real estate or things like that because it's so hands off. And what that does is it frees up management to look at acquisitions and figure it out from that perspective versus screwing around with the operating stuff. So Realty Income is the big triple net REIT, which of course everyone talks about. One of the largest REITs in the US that is consistently growing for, I don't know how long they've been around, 40, 50 years
Right.
at this point. It's just been a consistent grower. And that's the beauty with that is that there's so much of this real estate out there that, you know, Canadian Net is mostly in Quebec right now. There's all sorts of potential for them to expand into
Expand.
other markets eventually. I don't think they should really get excited about expanding quite yet.
Okay, fair enough. And I also valuation is the stock in expect.
Yeah, REITs, of course, their earnings are expressed in funds from operations and their free cash flow is expressed in adjusted funds from operations. That's a simple solution that gets us most of the way there. So Canadian Net REIT will do approximately 65 cents per share in funds from operations, FFO this year. The stock is, I believe, as we're talking right now, it's about 5.50 a share. So you're paying about 8 times funds from operations for Canadian Net, which is quite attractive, especially in a world where a lot of the similar retail REITs in Canada might trade at like 12 to 14 times. So it's much
Right.
more attractive versus peers.
Yeah. So currently trading somewhere around $5.50 CAD. Okay. Well, you already started to bring up dividend. So what is the dividend yield and is it sustainable?
So this one is right around 7%, I believe. The payout ratio is kind of in that 60 to 65% range of FFO, which is quite sustainable for a rate. A lot of its competitors are sort of hanging out in that kind of 75 to 85% of the FFO range. So it's much
Right.
lower than kind of the average Canadian REIT. And they've done that for a long time, kept the payout ratio low because they want to keep a certain amount of their earnings to the side so they can use them for growth rather than just paying it out to shareholders.
How would you rate the quality of the management?
So I've heard stories, I can't substantiate them, but I've heard stories where Canadian Net's management are hyper focused on growing FFO per share. That is their MO. That's what they want to do. And they've done a fantastic job of that over the years. You know, if you look at the company's previous results, FFO is just kind of consistently growing per share for a very long time. Now it's sort of flatlined in the last kind of year and a half, but higher interest rates essentially did that. They had some variable rate debt that sort of the interest rate went up and that cut into the earnings growth. So the growth has been there. I believe the growth is there going forward as well, especially as interest rates go down. They've also paid back some of that variable rate debt lately. So that's also going to help their results going forward. But no, I think the management here is good. I think that they will continue to, as interest rates go lower, they will find attractive deals. They'll put money to work and ultimately continue to grow the company and grow, most importantly, FFO per share. I think that these guys are pretty qualified to do that.
Yeah. So overall, you're giving the quality of management a thumbs up.
Yeah, I think that these guys are good managers. The other thing too, that the company, it's a very lean head office. I believe there were 3 guys in the head office and now there's 2. There's a CEO, a CFO, and then a CIO, a chief investment officer. And the chief investment officer was promoted to CEO and they were looking for a chief investment officer. I don't know if they ever found one or not, but even if they do, 3 people in head office is very efficient compared to just about every other REIT out there. And they can do that because of the triple net business model.
Do you see any threats or weaknesses or other potential downfalls that they may encounter?
The big one would be interest rates.
As with any REIT.
It started going up again. Yeah. And that's it for any REIT. They have a little bit more exposure versus some of their peers because they do have that variable rate debt. The other thing is that their balance sheet is pretty good, but it does have a little bit more debt than some of its peers. So they're a little bit more leveraged. And of course, that becomes an issue when interest rates go up. The majority of their debt is fixed, like a mortgage that, anyone listening would have, but they run the risk of having to renew those loans when the time comes, and higher rates make that a problem. Now, it looks like rates are going to kind of keep marching lower in the medium term, which should be a nice tailwind for these guys.
One last question on this small cap REIT. Why has it not gone up the share price as much as other REITs in the same, the Canadian sector, right? Canadian.
Yeah. This one is a little bit frustrating from that perspective because it bottomed out at about 450 and it's up to about 550. And there are other REITs that have gone up more. Some of them are kind of up that, Canadian net is up 20% from the bottom and really 10% from sort of the big move we've had lately in REITs. And you've had some of its competitors, some other REITs are kind of up like a lot more. And, there's a couple of reasons I think for why it has sort of struggled a little bit. One, it's small and a lot of investors just aren't looking at it. It's just like, hey, I'm going to bet on a REIT. I'm going to bet on a bigger, more liquid one. And two, I think is a little bit of those balance sheet issues that, investors want to see that they've sort of fixed these issues and that they can start increasing earnings per share again. And there's kind of waiting on the sidelines until they can do that.
Okay. Next up, the next small cap we are going to discuss is Richelieu Hardware. So let's hear the ticker symbol, little background. What do they do?
Richelieu is first of all, RCH on the TSX. That's the ticker. And they are a hardware distributor for contractors. So basically what they do is they have these specialty stores, these specialty shops where contractors go and they say, hey, I need all sorts of kind of specialty items, kitchen stuff, bathroom stuff. And they go in, buy it. They can kind of do a whole kitchen or a whole bathroom just from Richelieu's kind of showrooms. And then Richelieu will either kind of take it out of the back room, put it in the back of their truck for them, or to deliver it on site. So these guys deal with contractors because they also have a business where they distribute some of their more interesting specialty items to big box retailers, the Home Depots, Lowe's, even a little bit of Costco, things like that. They do that as well. So essentially they're a hardware distributor for the real estate business in North America.
So why do they only sell directly to contractors and not to consumers?
So it's a little bit of, there's an old bank robber, I can't remember which one. And they asked him, like, well, why do you rob banks? And he said, well, that's because that's where the money is. And it's a little bit like that with contractors, where it's like, if you're going to sell kitchen renovation supplies and bathroom renovation supplies and all these things, it's like the contractors have to spend money. That's their business. They contract out with someone. It's time to get to work, and where a Home Depot or something like that, those are still wonderful businesses too. But, you've got a lot more people who are going in, having a look, kind of needing to get inspired before they do anything. So Richelieu is very much just like, we know contractors have money to spend. We're going to focus on that.
Yeah, no, I understand exactly. Obviously, a contractor makes a deal with the homeowner. All of a sudden, that contractor now has to go and buy $10,000 worth of material, and they're going to get it somewhere, whether it's at Richelieu or Home Depot or wherever else.
Exactly. Richelieu is a little bit more of the specialized, and so they've tried to kind of build a moat there where it's like, hey, you need this specialized piece of equipment or whatever to finish a reno. Richelieu has it where Home Depot might not.
Right. It reminds me kind of similar to the Fastenal business model, where Fastenal only sells to other businesses. Like, you can't walk in there just as an everyday consumer with $20 in your hand and say, I need these nuts and bolts.
Yeah, exactly.
So it's a similar business model. Now, I do see that it has very impressive long-term growth. What is the secret there?
So every city has a few of these kind of specialized real estate distribution hubs, these stores that contractors go to buy stuff. And Richelieu essentially is rolling these up over time. So they will go into a market and they might own a store there. And then one of the competitors is like, hey, we're looking to sell. And Richelieu is like, hey, we'll buy that. And then open up another location in that city. But for the most part, it was like they started in Quebec, they sort of moved a little bit across Canada, and then they moved into the United States. They started buying stores there. So this is a very fragmented kind of business in the United States that Richelieu is slowly consolidating over time. And because it's not that large of a stock, is a few kind of these purchases each year can have an impact on both the top line and the bottom line. So that's how they've kind of
Right.
consistently grown over years.
Does that add to a little bit of a risk factor being a small cap and they're trying to expand into other markets?
Sure, if they go too fast and the balance sheet gets stretched, absolutely, that's a risk. These guys have been doing it for a long time and they have had success at it. So, I think that as it goes along, the risk gets kind of lower and lower. But that is definitely a risk over the long term, is that they get a little excited and they buy too much at once. But the fragmented market also helps there because it's like, you're not buying out huge competitors. You're just buying out mom and paw kind of people with one or two stores. And that makes it easier from a risk perspective.
And what's the valuation look like as of today?
So this one, if I remember, I think it's about 20 times earnings. They've sort of struggled a little bit lately. They had basically, like, throughout COVID, they had to sort of beef up their inventory a little bit because the supply chain was broken, and they were doing a lot of business too because people were buying houses and renovating houses during COVID. And so they had a bunch of inventory and now they're sort of trying to get rid of it. They're still struggling with that. It's a little bit. The real estate market was hot. The real estate market is not as hot today, especially places in the US, the US kind of Sun Belt region where real estate growth is very good. And now it's not as good. Rents are kind of starting to roll over. They're struggling a little bit today. And because of that, the earnings are a little bit lower than what they could be. And the valuation is perhaps a little bit stretched because we're waiting for that recovery. I also do believe that as we're recording this, the stock, if it's not at a 52-week low, it's pretty close.
Right. And what's the dividend yield?
This one is not that high of a dividend. I think it's about 1.5%. They have had a sort of a history of dividend growth over time. That is sort of in danger of kind of being a relic of history. They really haven't increased their dividend, I think, since maybe 2022, maybe even 2021. It's just kind of maintained at this level. And they have been a consistent repurchaser of their own shares as well, which has slowed a little bit as well as they're kind of working through these problems. So, if you're a long-term believer and you think that they can sort of work the way out of this and then get back to dividend growth and the share repurchases, then it's maybe a good time to buy. But the short term does not look particularly good. And that's causing the stock to be a little bit weak.
A little bit of cause for concern there, but overall, the overall outlook probably isn't that bad in the long run.
Yep. That's it. You look at what they've done for the last 30 years and it's just been this consistent kind of business plan of rolling up these small distributors. There's still lots of potential to do that over time. It's just that short-term results haven't been great. I find that I have a lot more success when I zoom out and I say, hey, this is a good long-term kind of play versus focusing on the short term. It's too easy to get overly negative if you focus on the short term.
When in doubt, zoom out.
That's it. Yeah.
So, okay. Now, obviously, you were just talking about people buying and selling houses during COVID. Maybe people are buying and selling houses all of the time. When people buy or sell a house, it leads to renovations. Renovations are the backbone of companies like Richelieu Hardware, like Home Depot, like Lowe's, like any hardware store or any lumber yard, housing, real estate, renovations, these are huge factors for these companies. So what is your overall outlook on, I guess, the entire North American real estate market?
Yeah. So this is one where I might get into trouble a little bit because there's a very vocal minority that says that real estate is overvalued, whether in Canada or the United States, mostly Canada. And, these guys get very excited when somebody shows up like me who says, and as I'm going to say right now, it's not a bubble. It's not terribly overvalued. Look, you have Toronto and you've got however many hundreds of thousands of people coming into Toronto every year. What do you think is going to happen to the value of real estate? And it's like that in virtually every kind of tier one North American city, whether it's Toronto, whether it's Vancouver, whether it's New York, Miami, like all of these cities where it's like you run into space constraints. And what happens in that scenario? Well, prices go up because you have to bid more to get the same sort of asset. And you look at, let's just build more houses. Well, it's not that simple because the permitting process takes a long time. These municipal governments have collected massive fees on developers and they're addicted to these fees and they need them. And so you can't just turn on you know, it's not like adding more widgets to a market. It's much more complicated than that. And it takes a long time. So overall, like the North American market, I'm bullish. I think that people are going to keep building. They're going to keep renovating and Richelieu will be just fine in the long term.
Yeah, I can't disagree with any of that. Okay, moving on to our third and final small cap in this episode, DRI Healthcare Trust. So let's give the ticker symbol a little background. What do they do?
So ticker symbol is DHT.un. There's also DHT.u, which is the US dollar shares of the exact same company. So these guys buy pharmaceutical royalties. So what happens is that a company will make a drug and DRI will show up and say, okay, we will give you a certain amount of money for this drug in exchange for some sort of financial arrangement. So they get paid on kind of on a per pill sold kind of perspective. It's like any royalty company, whether it's gold or, iron ore or oil or wherever. This one is just royalties on pharmaceutical drugs.
Okay. And why are pharma royalties an interesting business?
Yeah, that there are a number of reasons why someone might choose to sell a pharma royalty, which we'll get into. But there's the potential for a company to show up and say to the inventor of a drug, we're going to give you money in exchange for this drug today, rather than taking the risk of having to sell that drug in the future. That's very attractive to a lot of these companies or the individual inventors who make the drug, who come up with the drug. So then from their perspective, why would the company do it then? Well, the company can say, we're going to give a lump sum today and then in exchange get a good return on the investment over time. And there's a certain amount of uncertainty there, but for the most part, it works out over time. Everyone's happy and shareholders get an attractive return on their investment.
So why wouldn't the drug manufacturer want to sell? Why not just hold their
There,
patents and properties and everything else that goes with that?
Sure. So one is risk, is that don't really know how much a drug will do. It's all speculation. And it's like, if you have a very niche drug with a very kind of identifiable market, well, that's one thing. If you have a more general drug where it's like, we really think it's going to be better, but we really don't know, selling the option to a pharmaceutical royalty company, that's attractive because you lock in a certain amount of return on your investment. And if it's a company that has a drug versus like an individual, so sometimes an individual working at like a university or something, they'll come up with a drug, they'll, partner with a pharmaceutical company, and then they'll end up with a royalty on that. And then the inventor will say, you know what, I just want my money. I don't want to speculate on this drug I invented. And that's when the royalty company comes in. So they create certainty in an uncertain world. And if they do it right, they can make a nice return for their shareholders as well.
And then why DRI? Why this one? Why not buy any of the other pharma royalty companies out there?
Yeah, so there are a few in the United States that are publicly traded. There's at least one anyway. And I think there's another one that's just popped on. So the nice thing about DRI is that they've been in this business for a very long time. And I think it's about 30 years, 1987, I believe, was their first, as sort of like a private equity perspective. So what they would do is they would raise money from investors and use that money to invest in pharma royalties and pay out the proceeds for these guys. And the returns were quite good. They're anywhere from about 16 to 20% per year. So the returns are there, and these guys have a lot of experience doing it. And I think that they are kind of the right operators for me as a shareholder to partner with. The success has been there. And the other thing, the TSX stock is their first kind of attempt to have a publicly traded version of this strategy. And I think they're very motivated to make sure this one works so they can kind of continue to do that over and over again.
Okay, I was looking at the chart, and what happened to the stock this past summer? It was down 25% in one day.
What happened, and this is the part that's going to get some people excited, I know that, is the DRI CEO, who is also working for the stock. So of course, DRI does this with their existing investors, and then they have this publicly traded entity, and it all kind of goes through the same head office. So the CEO was fired for inappropriate expenses, essentially. So he's charging too much stuff back to the company. The company investigated. They saw issues there, and they got rid of the CEO. So that's what happened that day. The stock tanked, as it would, because not only did they get rid of the CEO, they got rid of him because he was breaking the rules and breaking a financial rule, essentially. But the company said the expenses that the CEO charged, we have reimbursed the trust, the publicly traded company, for those. There's an investigation. There will continue to be an investigation. So this happened. It was bad, but the board, in my view, did the right things by saying, hey, we cut this guy out immediately. We got rid of him, and it's time to move on. So it was a problem. I think the board has done the right thing to try to fix it. The stock has rallied pretty good since that happened. So the market kind of used it as a positive, but it was a problem.
Okay, so for those listening, just if you're taking notes, you are not allowed to charter a private jet and take your wife to Paris and the top of the Eiffel Tower on the company dime. I'm not saying that's what this guy did. I'm just saying that's an example of things you cannot company money.
That's not a good idea to do with company money. No, you will get fired.
Like this guy did. And we don't know exactly what he did, or at least I don't, but it sounds something similar to that scenario that I just made up. That was a completely made up scenario where he's just spent a whole bunch of company money on something that was not related to business.
So I don't know exactly what happened, but my understanding was that there were certain expenses that he was charging the publicly traded company, and then the existing company was charging like these expenses twice as what he was doing, padding his own pocket that way. But I don't know that for sure. That's kind of that was the speculation. Yeah.
Well, that is also wrong. You can't do that either. So, okay, let's talk about the valuation. Is the stock inexpensive?
So this one is quite inexpensive, actually. It trades what 7 times earnings, if I remember right. This one's a little bit tricky on the earnings side, because what happens is when they buy these royalties, there's these big expenses as they amortize these royalties on the balance sheet. So basically, it's like the value of it in year 1 versus year 9 is considerably less, and so you get these big write-offs in kind of year 1, year 2, year 3, but your cash flows kind of increase over time as drug sales sort of increase. So if you strip out these amortization costs, you get to about 7 times earnings today. Now, some people might say there's a reason why you have to strip out those costs, and that's a valid argument. But the point is that this thing generates a lot of cash flow. And they do pay a dividend, but for the most part, they take that cash flow and they reinvest it into more royalties at the pace of maybe like 1 to 2 a year. But, they're relatively big investments when they do make.
And so the actual current price of the stock is in the ballpark.
I think about $14 and change on the TSX for the Canadian dollar listed units, which are the most liquid. Those are the ones that I would buy if I was looking to buy.
Oh, now, and you mentioned the dividend, that they do pay a dividend, and the dividend situation here is a little bit weird. What's going on there?
So there's a couple of things that are weird about it. One is that they invest mostly in the US, so they pay a US dollar dividend. So that situation, it can look like the yield is smaller based on a lot of the websites you'll see out there. Will just look at the dividend is 8.5 cents a quarter US dollars. So they'll just take that amount and they'll say, okay, the yield is whatever that works out to be. I think it's about like 2% and change just based on that. But the actual yield is more like 3% because you have to convert that US dollar. So keep that in mind if you're looking at that dividend. And US dollar dividends are not that tax advantaged as Canadian dividends. So also keep that in mind. The other thing is that these guys will pay periodic special dividends. If they have a home run royalty investment that does better than they expected, and they have excess earnings, they will pay those out in a special dividend. They did last year. So you get that bonus as well, but that'll never show up when you're just looking at the quote on a website. So keep both those things in mind.
And then final question about the DRI Healthcare Trust. Why is the management fee so high?
So that's another negative for this one is that DRI charges the shareholders relatively large management fee. I think about 5% of assets every year, which is high, but this is a very specialized sort of asset class. These guys have expertise, and for the most part, the DRI management has been good. They make good deals, etc. It's just the one bad thing about DRI is the management that we talked about earlier. So that fee exists. I wanted to talk about it because a lot of people listening might say, hey, that's too high. I don't want that. And that's a fair assessment. For me, it's like, this is very specialized knowledge and I'm okay paying that fee. And the returns have been, with the exception of that big kind of decline in the summer, the returns have been pretty good on this one since the 2021 IPO. So management has delivered, even if that fee is high.
Okay, folks. And those are the 3 Canadian small caps for this episode of Canadian Dividend Investing. Nelson, before we sign off, do you have anything else you would like to add?
I just wanted to make sure that the people listening, that we know that one of my pet peeves, we talked about this in a previous episode, is that Canada is just banks and insurance companies and oil and gold. And it's like, I've always thought that's lazy analysis. And by profiling some of these small caps, hopefully I can kind of dispel that myth, is that there are lots of interesting assets in Canada if you just look
dig a little deeper
the hood. Exactly.
Deeper. Okay, with that said, thanks for joining Nelson and I on the Canadian Dividend Investing Podcast. If you are listening on Apple, Spotify, or any other podcast platform, be sure to hit the follow button. And if you're watching on YouTube, click subscribe.
Thanks for listening. Canadian Dividend Investing is a reader-supported publication. If you'd like to support the podcast, please upgrade to our premium membership option, which includes early access to episodes, 2 pieces of exclusive research each week, visibility into Nelson's portfolio, and much more. Visit CanadianDividendInvesting.com for more details.